Well, hi, I'm Taejun, and welcome to TJ's Macroeconomy.
During lunchtime today, I borrowed 5,000 won from Kyle because I forgot to bring ID card and I was trying to buy a meal ticket. Well, just like this example, borrowing money and lending money is very common in our daily lives. But there are times when 5,000 won isn't enough. For example, if I'm trying to buy a house or something or a car, then I need a lot of money. But then there are times when 5,000 won isn't enough. Basically, for example, when I try to buy a house or when I try to buy a car, I need a lot of money. And if I do not have that money, I start to get some help from loans, which is part of financial system. Then what is a financial system, first of all? Well, financial system is made up of financial institutions that coordinate the actions of savers and borrowers. So simply put, financial system is a system where financial institutions, just like bank, stock markets, or bond markets, make it profitable for both the savers and the lenders. Financial institutions can be grouped into two different categories. Number one, financial markets, and number two, financial intermediaries. Financial markets are the institutions through which savers can directly provide funds to borrowers. On the other hand, financial intermediaries are financial institutions in which savers can indirectly provide funds to borrowers. But let's talk about financial markets first. Financial markets are where, again, households invest their current savings by purchasing financial assets. What is a financial asset? Well, before we get to know about financial assets, we first have to understand what an asset is. So basically, simply put, asset is like wealth. So asset is anything that makes you rich and anything that has a money value. A financial asset is a type of asset in which the money value is derived from a contractual claim. Simply put, it is a asset where its money value derives from contracts, basically in a paper form. Physical assets, on the other hand, is a type of asset in which the money value is derived from a tangible and physical object. For example, a best example of a physical asset is house. The reason why house is a physical asset is because it has a money value. You can basically get a profit from selling your house. Well, there isn't much to explain about physical assets, but there are a bunch to explain about financial assets. Basically, there are four types of financial assets. Number one, loan. Two, bonds. Three, stocks. And four, loan-backed securities. The reason why there are four different types of financial assets is because the economy has developed into a lot of specialized markets, just like stock markets, bond markets, and banks. The first type of financial asset is loan. And loan is probably the most simple type of financial assets because basically loan by definition is borrowing something. So in this context, in an economy, when we think in macroeconomic ideas, when you loan, that means you loan a money to someone else. The example that I provided in the very beginning of the video, where I basically borrowed 5,000 won from Kyle, is one of examples of loan. In larger extent, however, if you are trying to borrow a huge amount of money, then you usually get a loan from the bank, which has a lot of money. But once you're in a relationship of a loan, you are in liability. What I mean by liability is basically a promise between you and the one who lent you money that you are going to pay the money that you borrowed back to the lender. We then move on to our second type of financial asset, which is bond. A bond is a certificate of indebtedness that gives obligations of the borrower to the holder, which is of the bond, who is the lender of the money. So basically what happens is that if you buy a bond, that means that you are promising the one who borrows you money, the lender of the bond, that you're going to pay the money back. So if you think about it, a bond is a financial asset from its owner's point of view and a liability from the issuer's point of view. But how does the owner of the bond expect profit? Well, not only is bond by definition a contract that states that the issuer of the bond is in debt to the owner of the bond, but the profit is also promised in a way that the bond has fixed interest rate that the issuer of the bond is obliged to pay. What is an interest rate? An interest rate is the proportion of a loan that is charged as interest to the borrower, and it is usually expressed in percentage. So for example, if I buy a bond from Dennis of $1,000 and I promise him to pay back with an interest rate of 10%, then eventually I have to pay back Dennis $1,100. Then we move on to stock. A stock basically represents a ownership in a firm where the owner of a stock, whom we call a shareholder of a stock, has claim to the profits that the firms make. So basically, if I buy a stock of, for example, an Apple, then if Apple makes a profits, then I am part of the profits. But the ownership is determined by the number of shares a person owns relative to the number of the whole shareholders. So for example, if a corporate, Apple that I just made an example, has 1,000 shares and I own 100 shares, then that means that I have to claim to 10% of the company's assets. And lastly, we have a loan-backed securities. Loan-backed securities are assets created from various types of consumer debt, which are also known as loans. This process of gathering individual loans and selling debt shares is called securitization. This process of securitization involves diversification, which is basically investing in various loans so that it lowers a total risk, which I'm going to talk about later in our next videos. Oftentimes, loan-backed securities are administered by a special entity, a person or an institution that owns the assets, and that special entity receives the creditors' payments, which are simply the lender's payments. Then it passes those payments on to various investors of the loan-backed securities. What's good about loan-backed securities is that, one, they give lenders a way to obtain cash for more lending, and two, they offer investors a way to invest in a diversified group of income-producing assets.